Here we go again. A firster,
Hey,
Tim Rood, joining one-on-one. How are you, Tim?
awesome, Greg. Thanks for having me, bud.
Oh, it's really, really great to see you. We've got a lot of ground to cover here. Of course, you were the director and the principal at Fannie Mae for a good close to 6 years. At one time, you were up for the big man's position at MBA. You were one of 3 finalists prior to Bob Broeksmit getting the gig. And now you are leaning heavily into the AI game, but you've not done anything about your ear to the ground in DC. And when I describe inside the Beltway, I see you. I see a picture of your face in my head. So it's great to have some time with you today. How are things going? How are you enjoying the current climate in terms of the mortgage industry? Give us your high level on where we are today. And this, by the way, following Chairman Powell's remarkable efforts to make sure we knew and know that a rate cut is not a certainty in December, because he had to say that to make the bond go up 15 ticks and rock everybody's world.
Not a foregone conclusion, I think. Yes. Yes, I understand. No, thanks for having me, Greg. I'm happy to cover any and all. It's so funny. I had somebody who was a former FHFA director recently who sent me a note. He's like, man, wild times in the industry. And I kept thinking about the movie Crazy Stupid Love with Steve Carell. I was like, how so? Like joking. I mean, it's wild. It's for people who have been around this for a minute or two. I just say it's on the surface, it's unconventional. At times it feels a little ham-handed, but then I look back at the time where I was at Fannie Mae and I think about when I left the place, and I have a lot of dear friends there. And I think my parting words to the president, I helped run a skunkworks program there. That was sort of our take over the universe strategy during the e-business days. And I remember when I left, we were having our 4th kid and I was leaving. I was like, I can't wait to come back to this place when there's 400 people working here. Meaning back then, when there was half as many people, it seemed like there was probably a fair amount of feather bedding and maybe a little extra talent that didn't need to be there. Depth of talent and the brilliance is amazing. But yeah, no doubt these are unprecedented times. And I think for a lot of casual viewers on the sidelines and even institutional people in DC, they're a little befuddled by what's going on, and probably, this is a pearl clutching sort of town. There's a lot of folks with that are gasping, trying to figure out what's going to happen, and are appalled by certain actions. But I've slowed down recently and tried to be critical about some of the sort of the moves. And the easiest ones to talk about, of course, are FHFA and the GSEs, right? Those are the biggest moving targets. HUD seems to be stationary. VA ripped to John Bell, who's a dear friend and a wonderful human being. We can come back to that. The GSEs, though, are certainly in play, and trying to figure out exactly what the play is the $1 million question, I think, at this time.
Well, yeah, I know you have an opinion on that. So why don't you lay it out there in terms of whether they're going to come all the way out of conservatorship, and is there going to be a public market offering?
Well, it's interesting. I mean, it's anybody's guess. It's even Pulte would tell you it's up to the president. And what I would say is about what I'm finding about Director Pulte is I'm trying to be a little bit reflective in the sense of, again, what would I do if I was there? And if you're looking at this objectively, I'm thinking about, again, him in that seat going in there, and you think, okay, give me the playbook. What have we been doing? It's like, okay, good, no problem. Yeah, for 60 years, 70 years, 90 years, depending on what your benchmark is, the federal government has been backstopping the mortgage business. We want to promote homeownership. We want to promote affordable homeownership. We want to close the homeownership gap. And you know what? Here's $17 trillion. Have at it. Do what you got to do. This was even before the civil rights movement, that the civil rights bill. You still haven't seen any appreciable increase, and in some cases, decreases in home ownership rates or in minority home ownership rates. They've actually dropped. So I can imagine the energy and enthusiasm that Director Pulte is showing coming at this with fresh eyes, going, man, give me $1 trillion and let me show you what I would do. But that aside, here's how I see it setting up, at least right now. There's a million unanswered questions, particularly, again, with the plan. What is it? And what I do notice as you're looking at the chessboard is there's a lot of activity at Fannie Mae and very little activity at Freddie Mac. You can read that a couple of different ways. I see it as Fannie Mae is slightly bigger. They're closer to exit than Freddie Mac, although Freddie Mac has improved from a market share perspective better than I've ever known them. They've got a higher market share, single family and multifamily than Fannie Mae. But there's no doubt the lieutenants, the political appointees, there's a lot of assets that seem to be moving over to the Fannie Mae side of things. So I don't know if it's one twin eating the other or if that's just closer to exit than Freddie Mac. But those are something that's a good place to start is what's going on there. What do those movements mean? And I'll pause to let you react to that
Yeah,
first.
well, I mean, we're seeing like musical chairs there, and so we were seeing a flurry of activity with people going in, people going out. I don't remember a time cumulatively, if you added up all the headlines in and around the GSEs, I don't remember activity like this. So what could it? What's your best guess on what it means? I mean, clearly you've just given us a glimpse into your mindset that Fannie could be more advanced or something really substantial could be happening there.
Well, the challenge is that I think we talk about these things as sort of one thing. There's GSE reform, there's getting the GSEs out of conservatorship, and then there's housing and mortgage reform. They're not exactly the same thing. So if you're just looking at, just call it GSEs and getting them out of conservatorship, to me, it looks like, I mean, anything that involves a private capital, like an IPO or sort of a club deal or a syndicate deal on the side, they're going to have, you presume, some line of sight into what they're investing into. Is this going to be government backed implicitly, explicitly? What's it going to cost? Are you going to lower credit fees now just when I'm about to invest? Take me through that. I think there's a lot of unknowns at the moment that need to be sort of fleshed out. My knee jerk reaction is it'll be very difficult. You can't gain consensus because you don't have a plan to gain consensus around. So you have, my mind, a camp that's a little bit Pulte with Lutnick sort of style folks, very business oriented folks. If the government's going to play a role, then we want a slice of the action. Those are those people I can relate to on a lot of levels. Besant, McKernan, and Calabria to some side are the technicians. They're more opera, I don't want to say practical, but they're technical in terms of, well, I understand where you want to go, but that's not the way this system works. So those two are going to have to come together to solve for whatever the plan is. But I would say that anything to do with Congress, we all know is a moonshot. So
Yeah,
I don't
yeah,
expect
for
anything
sure.
like that to happen. So the best I could hope for in the near term, in my mind, is you do some side of a sidecar deal where you get a group of investors that would come together. The government carves off a ham bone size slice of equity, warrants, senior preferred stock, whatever. But I don't know what the combination would be. But I can imagine that sort of a deal going down. You sell off 25, $30 billion perhaps of equity. You keep them in conservatorship, and then you set yourself up for potentially 2026 or later, an IPO, a relist, and now you've set a level of value for the companies that it's probably pretty
Yeah.
good.
Well, so for the people that are boots on the ground, where they're hearing this and going, you know what, that's cool, that's super high level, but how's that going to impact me on the street? Any insight there in terms of what it might look like if that happens and Fannie is all of a sudden publicly traded? What that looks like? What do you think?
It really depends on how they do it and when they do it. It's the terms of it. Obviously, the devil is in the details. They're not going to do anything that's going to disrupt mortgage rates. So that's a little bit of the conflict too, is at the same time you're trying to raise capital, you're looking at, and you've got Barry Habib in there, it's a very smart guy who's looking at LLPAs and credit fees. It's hard to entice people to invest in the company right at the same time you're looking at potentially carving up their margins or lowering their ROI. And remember, going into the crisis, the GSEs, I'd say their G fees, their fully charged fees were about a quarter of what they are now, which is why you see these things are like two-headed monsters coughing up $100 bills every half a second. They've never made any kind of money like this before the financial crisis. So there is room, you would think, to trim some of those. I just don't know how consistent that is with valuing the companies and enticing investors at the same time as serving that public purpose.
I like how you broke it down between Director Pulte and Mark Calabria and the two camps. The technicians and the ones that want to get stuff done on the business side. It is very interesting to look at it from that lens. I mean, the way I look at Director Pulte and what he's trying to do is, at least he's talking about the things we've been talking about for the longest time. I mean, we've been screaming from the mountaintop as an industry about the credit issue and FICO's monopoly and LLPAs and how they're unnecessary and too much. And so, like, the fact that he's talking about it, yeah, maybe he's talking about it. Well, not maybe, he's talking about it before really you can make the changes, but at least he's putting it on the radar and saying, I know we need to get this done. Let's do it. And to me, I don't remember hearing anything like that under the Biden administration. So I'm enjoying that. I find it refreshing. If he says that stuff and the technicians need to come in and implement it, whatever. Like, if we can. Look, it's been a year, right? It's been almost a year, not even a year, right? We got 10 months into this administration. They've called out FICO. They're bringing on competition there with VantageScore, we hope. He's looking at LLPAs, trying to right size that. We're looking at getting GSEs out of conservatorship eventually, which they were never intended to remain in there forever. Those are three massive, massive things. And they've also done other things to pull back, the cost of doing a mortgage. Which I've heard you talk about with Neil Cavuto and on Fox News, and and I've seen you on CNBC. So you've tackled these issues before. Let's talk about that. Like, any hope that the changes they've made on that front is going to help to lower the cost to produce a mortgage?
Well, here's some perspective, Greg, is that when I was at Fannie Mae, so this skunkworks program that we were involved in, we were trying to take the cost to originate from, I think it was $2,500. Take a minute and wrap your head around that, to somewhere north of or south of $2,000. Now it's somewhere around $12,000, right? The cost to originate. So is there room to improve there? Hell yeah. We all know that the $10,000 is what it's for. It's a premium. It's a quality tax. It's a whatever you want to call it tax. It's all of the things that came after the financial crisis, which was to de-risk the loans, but it didn't de-risk the institution. So yes, they achieved that, but at what cost? I mean, I think about it. I remember when Dodd-Frank came out in the QM rule, that the idea that you would legislate the credit risk that I could take, that was mind-bending because you took it a step further. And that meant if you're telling me the credit risk that I can take, that means you're effectively telling borrowers, hey, Greg, I don't think you're ready yet. You know what? When you get your DTI below 44, we'll talk. I'll call you and I'll let you know. It's like, you know what, dude? Stop helping me. You just caused the cost of mortgage to go up by $10,000, and I can't even get one even if I wanted one. So I think there's a tremendous opportunity there. The idea of things like Palantir getting in the mix, whom I've worked with in the past, wow, those guys are impressive. The idea that they're going to get in and help the GSEs figure out, obviously, how to bring efficiencies, how to root out fraud, all of those things are going to reduce the cost to originate. They'll probably reduce the cost to originate by extending some of their services closer to the point of origination without breaching the bright line. But I think for sure you'll see costs come down. And we obviously see a lot of energy around construction, financing, opportunities for builders to do more. That could
where
help
could that take
supply.
us? Where could that road take us? Let's talk about builders, because obviously that's that's the Pulte name right there. So how could, like, for starters, it's very hard to do construction lending, to get set up to do construction lending as an IMB. Not all of them do it. Many broker it out. You see a path where they could make it easier for more people to get involved in construction lending?
I think they're going to have to, if they're going to get into it and push it, starting with just the builders. I mean, look, if builders are sitting on 500,000 or 2 million lots, whatever the right number is, and buildable lots, they're not doing it because they don't like making money. They're sitting on it because they like to make money, and there isn't either a market or a market that pencils out for them to do this. And while I love the idea of Director Pulte pushing them to, I mean, look, I hate the status quo. Anyway, that could be my least favorite term in the world. The idea that the status quo is being challenged by Director Pulte to push the builders to think creatively and even offer up potentially acquisition construction financing on presumably better terms, but that would have to be a portfolio product. I don't know how you would securitize it, My hope is that it would compel the builders. My hearing and sense is that the builders are very reluctant, and the only way on some of those, they're reluctant, and the only way that they're going to be less reluctant is you're going to have to pull some of the reps and warranties away from this. So you de-risk that side of the business so that they can, more consider seriously some of the financing options that are being proposed. But that means at the same time, the IMBs, who are, to your point, would love products, any new product, construction products especially, but they might be ill-equipped and they're probably going to be risk averse enough to really require some sort of relief on the same terms, similar terms as the builders would require, rep and warranty relief.
Yeah. Let me ask you about non-QM loans. They're all
Mhm.
the rage right now. They continue to pick up a lot of momentum. I think they were 3% of the market share 2 years ago, something like 5% last year. They'll be 8% this year. If they go up 50% again, they'll be 15% in the next 18 months.
Yeah.
Like, any concerns about that? I've tried to raise some alarm bells, and I think privately people have called me that are very close to loan quality and loan performance and said you're onto something here. I don't know why publicly more people aren't raising their hands and asking the question, should we pause or slow down a little bit?
Well, you'd have to tell me about the composition of those loans. I mean, I suspect that they're happening because there's some
Appraisal issues
just
or appraisal issues, lots of appraisal issues is one aspect. I mean, the other thing is that the lion's share of these loans are DSCR loans, which hinge on rental income. And if we're
Yep.
entering an environment where values are about to come down and potentially rents could come down, right behind it, are we building a house of cards? That would be the context.
I mean, I think we're generally obviously going into a far riskier environment than we've seen in a while. So QM loans, non-QM loans, I think obviously that everyone's concerned about the household stress. The non-QM loans, look, I mean, I was around probably just like you were. There was a point in time where you could responsibly originate some of those more creative sort of no docs and stated income loans and things like that. We're not to that point yet. I think the DSCR or commercial purpose residential things, they certainly have their place, and it sounds like they're moving in that direction because of better execution, slightly easier terms in terms of papering out the files. I'd hate to think, and I'd shudder to think that anyone was using them because of some dubious appraisal practice or maybe less stringent analysis by the buyers. Those are the things that we know are sort of the match that leads to the boom, and I'm trusting and hoping that's not the case. Are you hearing that that's where it's headed?
Yeah, we'll see. We'll see. I think my concern is just the past, right? I mean, that people rushed into option arms, they rushed into subprime loans. Like anytime the market has paid up and paid up aggressively, and from what I hear, they're paying up more than on just vanilla conventional loans. When there's this kind of robust appetite for something non-traditional, that scares the shit out of me. So I don't know. Maybe it's just
Amen.
years of the past. Maybe I've been in the business too long, but I want to get to the big headline here. I've
Yeah, sure.
teased long enough. I've not gotten to the elephant in the room, which is what I described when kind of teasing this great conversation I'm having with you, and that is banks.
Sure.
You have a very, very strong opinion about banks, their current involvement, and soon to be greater involvement in the mortgage space. Give us a lens. Open it up.
Yeah, this is a hypothesis, right? So I mean, obviously we're in plenty of conversations. The things that I'm keying in on are, of course, you're looking at. There's always the threat or the concern in the federal government of IMBs. It's been talked about since, I remember Greg Keith first raised it in probably 2015, right? The capital liquidity requirements and then the concentration risk. But we all recognize that the IMBs, those are the ones who have done, the yeoman's work of stepping into the void when the banks left and did the thing that that America needed and required of them, stepping into the abyss and originating loans when the banks wouldn't originate loans. I think we're coming to a point in time, though, where look at Besson's comments, especially Secretary Besson over at Treasury, where they're looking at the concept of, look, there was regulatory overreach, to say the least, but for a political agenda. Okay, all of that added cost, all of that added complexity, all of that added fragility to the systems. And specifically for banks, they're very explicit about we're going to deregulate them. Trump has talked about lowering their capital levels by, I think it was the lowest that they've been in 10 or 15 years. You're going to have to make some reforms to QM on a couple of levels, QRM, QM, to just basically take those down because of the cost. Those are largely were attributed to the cost associated with that $10,000 delta between yesteryear and today. So I think there's a lot of reasons to think that the banks, as you lower the regulatory requirements on them, you lower the risks. I mean, from the capital or lower the capital requirements to be in the mortgage business, to be in the mortgage servicing business. It's hard to argue that they didn't like the mortgage business before the financial crisis, largely because my experience from at Fannie Mae was a lot of the big banks back then didn't even measure the success of a mortgage in economic terms. Back in the early 2000s, they measured them in terms of wallet share, market share, cross sells, referrals, things like that. So there's a million reasons for the banks to be in that business. And take a look at things like Jamie Dimon, who swore off for good reason the mortgage industry because of things like the False Claims Act case. You know, that's the same person who swore off crypto um, long for forever. And then just 2 days ago, he's like, meh, yeah, we'll start using that as collateral. I think that the administration seems to be wooing the private capital back in, either on an IPO basis, generally just getting private capital back in. And there's a lot of reasons for them to come back in to the mortgage business now. And I'm sure the federal government would love the prospect of it. I'll
How
stop there.
frightened, how scared should IMBs be or leery of that in terms of they're already looking at Rocket and these other entities, Freedom getting bigger and Lakeview stepping into the origination space with Guild. I mean, there's a market land grab going on right now, and so if you layer that with banks leaning in, my goodness, that does not paint a very pretty picture for the smaller companies.
I'm sure the banks would move in very gradually. They're never gonna, unless there was no administrative way to give them the confidence to go full bore. It would have to be some sort of a legislative fix at a minimum for things like the False Claims Act case. You remember Brian Montgomery last go around in the Trump administration, they did a memo of understanding with the DOJ, just like, let's just chill out. Let's say before we bring a case that you'll talk to me, FHA, since you're bringing a case on my behalf, maybe I'd want some input on it. That had a little effect. So I would see this as a gradual change until, right? Fill in the until. I think you're right, obviously worrying about the concentration on the IMB side. And I don't think that that's lost on the administration, that having IMBs that have, I think the argument has largely been, not my argument, that there isn't a regulatory framework for a resolution framework for dealing with a large IMB. I don't think any of them are systemically important, but dealing with a large IMB. So in the absence of that, there's obviously agita in the administration. And when they think about how they've managed it to date, is like, okay, well, we'll just increase capital and liquidity requirements for the IMBs. And anybody with a rock in their head would turn around and say, yeah, we can do that all day, champ. But all of that passes through. It passes down to higher cost, higher rates, probably worse, not worse service in that case, but certainly higher rates and higher costs. So at a point in time where that seems to be the measure of success, how low can we get interest rates? Then that's a difficult decision to make, to raise those capital levels. So as you look for a counterbalance, well, what else do we've got? Banks start to make a lot more sense.
Well, you made a great point to me with regard to banks around the flywheel, because I asked you what you thought of this concept of what Rocket's trying to do, where they think the consumers want, and Stan Middleman told me this too last week or at the NBA annual. He says absolutely the flywheel is going to be a thing. Like if you can serve people in one place, they don't want to move around. And you made the point to me, geez, this is tailor made for the banks with all the different verticals they have.
No doubt. Yeah, I mean, I love this. We used to call it vertical integration, right? So, or bundles. That's what they were leading up to the crisis. They do it because it works. I mean, you know better than me that selling something that an existing customer is 10 times or is a tenth of the cost of acquiring a new customer. So I'm fascinated by the consolidation. I'm not in the origination business, so I can be an observer, but I am fascinated by it, and I can certainly see the value and how this does pick up steam. It'll be interesting to see how retention rates go. If you can maintain what Rocket claims in terms of their high retention rates, that feels like a mortal threat to a lot of people. But I can't help but think back to, I guess I'm older than I thought, Angelo Mazzillo days when he had called it 20 years ago. He's like, you're going to see two worlds. It'll be a barbell. Big guys who are the aggregators, everybody else will be a little guy who's originating, nothing in between. And it feels like you're sort of going in that general direction. I mean, I love the big servicers because I think they built a ton of efficiencies. I think they've gotten creative about capital, but there's all sorts of risks that the government thinks about in terms of counterparty risks, not just for the servicers, but then the technology companies that support the servicers, that support the originators. And where does this capacity go if you have a flame out? I think that's another reason and example for banks, but that also puts pressure on the GSEs and Ginnie Mae to some extent saying, hey, look, you guys are supposed to be the resolution framework. Where's the resolution framework that the federal government would support and get behind and maybe mitigate the risk that they see as this ambiguous threat with no clear response?
Fascinating conversation with you. I'm loving getting into your brain here. There's a lot going on in there, man. You have a lot of compartments. So thank you for opening up what I'm sure is just a fraction of them. Let's talk about what you're doing now in your capacity as founder and CEO of Impact Capital in Washington, D.C. And tell me about Alfred. I understand that you're knee deep in the AI transformation going on right now. Tell us, we can't have a conversation without mentioning AI. Tell us what you're up to and how you see that impacting the mortgage world and what part you see yourself having in that.
Yeah, no, thank you. I mean, it's funny, the reason that we ended up selling the Collingwood Group, which was a huge advisory business, professional services, all DC stuff, which was great, is we couldn't find a way to syndicate the knowledge between all these smart people. So I was like, man, I am not going to be the guy who's 75 years old at the bottom of an escalator at an MBA conference flicking business cards at guys' heads. Like, that seems like the road that we're on. We need to find a business with leverage. This has no leverage. I'm out. And that and a couple of things caused us to ultimately sell the business. Lo and behold, 2023, you start to see ChatGPT, other things come online, and you're like, light bulb. That's how you syndicate the knowledge. You basically train a model. We graduated from that idea and basically decided that, you know what, the real estate industry is what, $70 trillion? It certainly warrants its own sort of AI platform. You don't need horizontal things like ChatGPT and OpenAI and things like that, or Perplexity that could work for your use case. I wanted something just like we're talking about that was vertical, that was something built for real estate and for mortgage. And so what we ended up building out was just that. It was a platform we called Alfred, the flagship product. It came out really as almost like a Bloomberg terminal where you would have information that had thousands of touch points, endpoints, integrations into the federal government, that was pulling content that we were curating from our crawler from the internet that had regulatory data, interpretive guidance, all the things that we all think about day in and day out. And it started with just answering questions. But quite frankly, that's plenty. That's great. But I didn't think that was a business. We wanted to graduate it to actually doing projects. We upload a bunch of different files, synthesize them, do presentations, work groups together. And then we ended up using that, basically the logic, reasoning, and the knowledge behind Alfred to push it into enterprise solutions so that people could improve efficiencies, productivity, mitigate risks and losses. It has been a wild ride. Wild ride. Lot to learn and a lot to do. But
yeah, and I have to say that you author what has now become my favorite thing to read, The Daily Dose of Real Estate. Tell the audience about that and how they can get their hands on it. I mean, is that related to the AI you just described, that you're going into all these different channels and pouring all of the stuff germane to the industry into one place? Because that's what it feels like to me. I mean, this is like my morning Bible when I get up now.
Well, thank you for saying that. So doing TV as I had done, or anybody going to a meeting, like, so, okay, let me read an article. It's like, I just read this damn thing for 15 minutes and it was worthless. God, son of a bitch. All right, fine. I instead wanted to, like, how do you just bring the content to the surface? I'm smart enough to figure out that if you can give me headlines with a little bit of context in an order that makes sense, so you can give me the tapestry of what's going on, I'll feel a lot more informed than if I read one article about a reg that's never going to get passed and who's pissed off about it, yada, yada. And the only way we could do that was because we have our own proprietary internet crawler and scraper that I've targeted to, I think, 250 sites that are specifically related to mortgage topics, economic topics related to mortgages, regular topics related to mortgages. So if you went on, ChatGPT or Perplexity or any of those and tried to do the same thing, you're going to have an unsatisfactory experience. And I used it for myself. I teased it out with a couple of friends to think if it was too Kafka, too short, and everybody loved it because you could be through this thing in 3 to 10 minutes and on your way to actually having a productive day and feeling like and knowing that you had a good pulse on everything that mattered to you.
Mm. I mean, this is just
Now, with you
amazing. I'm
that blew
looking.
that up.
Yeah,
Go ahead,
I'm
sorry.
looking.
I
I'm
didn't.
looking. It's okay. I'm looking at today's daily dose of real estate for October 31st. I mean, it goes on and on and on. I can't believe you're able to extract so much stuff that's important to me. You're doing a great job, and I just have to tell everyone they've got to get a hold of this. Like, what does it take to get your hands on this newsletter every day?
So it's you can get it through LinkedIn. You could go to our website and sign up for it. We actually took it and blew it into, as I mentioned, a Bloomberg terminal. So you can get an electronic version of it. What the newsletter you're seeing is basically, that's the raw guts of it. It's just showing you the content that we're consuming for that period of time, usually within a 24-hour window. This dashboard, this Bloomberg terminal that we have, has all of the news together with the economic indicators, with all of the stock analysis, in addition to the 10 Qs, 10 Ks, all the meat of all the strategic planning and risk profiling of these companies. Two ways of doing it. You can read it certainly online, and you can certainly go and use our Real Estate Intelligence Hub for a more fulsome interactive experience. But yeah,
Is this free? Is this free?
Yeah, it's free.
How are you making money, man? You must be doing some other things. This is valuable.
Well, we're
I would pay,
selling other
by the way,
things.
I would pay you. I would pay you for this, just so you know.
I'll call you after this. The idea of this was to
I
demonstrate
didn't
that
say I
we
had
have.
any money. I didn't say I could pay you. I said I would pay you. I would if
Well,
I
this is
could.
a way of, this is just a good way of kind of socializing some of the things that we're doing. And just like you're smart. You've seen every AI tool out there, and still people scratch their head going, "How in the hell did you do that?" Well, you can't do it with conventional tools. You need to build out a platform, like I said, that was real estate specific, that thinks and talks and considers real estate the way that we do. And it's almost like if you took a a high powered magnifying glass. I think about like the chat GPTs of the world. They're applying that to an ocean of information, right? And they're generalists and they're fantastic. I'm taking that same horsepower and I'm applying it to a Olympic sized swimming pool of information of all the shit that I thought that was important, of all the things that are relevant to our day-to-day lives. So it simplifies it and it makes it so much easier to get to the content, the answers, and the attributed information that you really want. You need to know the sources, you need to know the context that it was presented. And that's the only way you're ever going to get to these enterprise solutions that mortgage companies and real estate companies are all looking to achieve with AI. You ain't going to get there without trust and transparency. And this is a big leap forward to the trust and transparency that I hope will lead to the enterprise solutions that we're building and implementing.
Yeah. So, who is your client, and what is the base case that you see the most of currently?
Sure. So we're building out these intelligent chatbots where you're looking at tools for engagement. How do you engage customers when they get to your site? You build out an intelligent chatbot that leverages as much of the content that we have. Again, any of the government information, rules, regs, SEC stuff, economic data, and you string it together so that you're answering questions, you're solving for the problem that the customer came to see you for. Whether it's about information about a mortgage, whether it's about a property I might buy, whether about it's a pro forma for a property I'm thinking about investing in. We're seeing a lot of opportunities in the DSCR, multifamily, commercial real estate space for those sorts of tools. And then we're seeing a lot of opportunities where that dashboard that I'm talking about, where it's basically 4 or 5 great tools under one pane of glass. I'm just peeling those off and we're selling them as APIs. If you want the new service, Greg, that gives you all of that, things like the daily dose, you can license that. If you want our SEC tools that give you the insights into all of the companies that you want in visual and data form, I can give you that. Same thing with economic indicators. And then we're going downstream and implementing what we call intelligent document processing, which is how do you take that data, how do you take that logic and reasoning, and then move it into a process to drive the efficiencies that we've all been talking about for 30 years that now are right on top of us.
Fascinating. As we mentioned at some point in this incredible conversation, you were vying for the CEO president job at the Mortgage Bankers Association. Didn't work out then, but would you reconsider down the road? Is that a position that you still think where you could make a big impact and it might be enriching enough for you to want to take it on?
I love what I'm doing. That seems like a hard job. I give Bob Broeksmit a lot of credit. I mean, the interviewing process was hilarious, and I'm glad I went through the experience. I think Bob has turned out to be a very good steward for the MBA. I think that's a tough professional organizations are tough. It's got to be particularly tough for him right now. I've got my hands full, and this is where I see the future. So I think I'll stick where I'm at, Greg. But thank you.
Man, that's a perfect way to put a bow on this. I said that you were inside the Beltway. That was a very inside the Beltway answer. Good job. I love that. Tim Rood, founder and CEO of Impact Capital. I hope that we can do this more often. I think the audience is going to love this. So I will reach back out to you. I hope you'll say yes.
Anytime, brother. Anytime. Thanks for having me. Be good,
All right,
everybody.
enjoy the rest of your Monday. Take care, everyone. Bye-bye.
Good night.